This is the last video for this series of why retail investors always lose money. So this time we will discuss the last two related concepts, how retail investors lose their principal and what is the most dangerous situation for the stocks. There are many institutional investors in this stock market, but the number is certainly not comparable to the number of retail investors. But it is always the institutions that make money, and most of the time retail investors lose money. So where exactly are the differences between retail investors and the institutions? First, most retail investors do not have the ability to correctly interpret and process related information and news. This means that retail investors cannot make money by reacting correctly to the news. Even most of the time, the interpretation of news is wrong, resulting in losses. The core gap between retail investors and the institutions is reflected in the ability to process the key information and using that processed information to select the stocks. Institutional investors have more powerful information processing ability since they are hired as professional analysts. Also, they always get much more detailed information than the retail investors. The most interesting part is data shows that the smaller the amount of the investor's capital is, the weaker their stock picking ability is. The second aspect is transaction frequency. The average turnover rate in the market is not very high, but many retail investors prefer to change their stocks very frequently. From the overall results, statistics shows that high frequency trading leads to serious losses. To sum it up, the main reasons for retail investors to lose money are likely to buy stocks based on news, but most of them do not have the ability to interpret the news correctly. Likely to buy and sell stocks frequently, and the trading skill is not up to the mark. Lastly, let's talk about the most dangerous situation for a stock. In fact, it is very simple. The most dangerous situation is nothing more than the complete necrosis of the company's fundamental. That means financial fraud. Once a company is found doing financial frauds, it often faces a continuous plunge in stock prices or even delisting, leaving investors deeply stuck or even losing all the capital. Blindly pursuing investment returns and not checking the financial risk of the company may end up buying companies with financial issues. To prevent the risk of buying such stocks, investors need to have relatively deep financial and accounting knowledge, and they need to be able to find the unusual clues from the three financial statements and related announcements.